For more on this, we're joined by Vicky Pryce. She's Chief Economic Advisor at the Centre for Economics and Business Research. Welcome back to the programme. Vicky, first of all, what are the main drivers of inflation in the US last month?
Well, I'm afraid it's energy costs. It wasn't particularly surprising that this would be the case. If you look within the CPI, the Consumer Price Index in the US, there was an increase year on year in energy costs of 23%, 23.5% or thereabouts. So really quite a substantial increase. And if you look at core inflation, so if you take out food and energy costs, then we really are not talking about anything huge that happened over the month. In fact, the increase of which was just 0.2% month on month was slightly less than what was expected. Core inflation is not really seriously picking up, but it really is energy costs. So when you quoted in the bulletins of President Trump's comments, the interesting thing is that if indeed oil prices, energy prices start coming down, then that inflation prospect for the US could start looking a bit more benign for the future. But for the moment, while oil prices are high on a year-on-year basis, if you're looking at particular months, then we still have this problem that energy costs are considerably higher than they were a year ago.
Markets are rapidly repricing interest rate expectations. Do you think investors are currently ahead of central banks or behind the curve?
That is actually very interesting because certainly until now, and still the case, even after the inflation data came out, the expectation is that the Fed isn't going to increase interest rates next month, even though quite a lot of the underlying sort of trends that we've seen in the economy would suggest that they should. We got very good jobs news coming out last week, which showed the economy is actually doing a lot better than perhaps what people were expecting. So there is strength there despite everything. So there would be just justification for raising interest rates in the next meeting. But I think we're getting some hints that perhaps what the Fed might do instead is maybe tighten monetary policy, but just reducing its own quite enormous balance sheet. So reducing liquidity, in other words, in the markets. And if that is the case, then it's more or less equivalent perhaps to increasing interest rates. So a very fine balance, I think, in terms of the decision. But the markets seem to think that overall interest rates may just not go up, unlike what may be happening today in terms of the news from the European Central Bank.
So this is Kevin Warsh's very first month as Fed chair. Trump had handpicked him expecting rate cuts, but this new inflation data and last week's job figures basically scream for a rate hike. How does Warsh handle this political tug of war at the next meeting?
Well, we'll see. I mean, that would be interesting. But I think he may well argue that this is transitory, temporary, but at least we're not heading for cuts, which is what perhaps the president would like to see. And there had been an expectation that maybe, just a few months ago, of course, we would be in a situation where we'll be on the downward path for interest rates. Well, that hasn't happened in the US. It's not really happening. It's not happening elsewhere either, well, in most parts of the world. So I'm afraid we are stuck right now with this high inflation environment. And there could be worse in terms of where we might be next month in terms of the inflation rate, because what is happening is that this energy price increase, even though I did say core inflation is not really picking up as much as would otherwise be expected, but it is filtering down to all sorts of other costs, not just gasoline prices. It's true that they've come down a little bit in the US recently, but it is throughout the economy. And there are some other inflation indicators coming out today and also next week, or later this month anyway, which might be affecting what the Fed may be thinking for the future. So there are more worries ahead. And I think for the moment, it makes sense, probably, as the markets think, to stay put and wait and see.
Vicky Pryce in London, great to speak to you as always. Thank you.
Thank you.